Nikita is financial analyst at PHC Advisory Tax and Accounting. He advises our clients on tax, HR compliance, and other financial related issues in the APAC region, and assists our clients in FDI, taxation, and compliance in the Indian marketplace. Today, he will give us a fiscal overview and tax incentives in India speech. Nikita, please, the floor is yours.
Thank you, Veronica. Please allow me to share my presentation with you. I hope you can all see it.
Yes, we can. Thank you.
Okay, perfect. So once again, good afternoon, good morning, depending where you are from, dear viewers and dear speakers. Thank you very much for the intro, Veronica. And I would like to welcome once again everyone to this very interesting and wonderful event with our esteemed speakers. It's my pleasure to be here. My name is Nikita Polishchuk. I'm the financial analyst at PHC Advisory Tax and Accounting, part of DP Group. So in today's presentation, I would like to touch a little bit on something which is of very great importance for both prospective investors into India, but also to some who already have a presence in India. And I'm talking about, of course, the fiscal overview and also tax incentives in India. So in today's presentation, I will follow this agenda. Essentially, I'm going to introduce the three main taxes in India, which are goods and services tax, or GST, corporate income tax, or CIT, personal income tax, PIT, and I will touch a little bit upon some other taxes which are relevant to foreign investors and which are often the focus of our practice area in India. And finally, I will talk a little bit about something very nice and something what foreign investors are always looking into when deciding on their FDI in India, and those being fiscal incentives. So first, let me start with introducing the goods and services tax. So goods and services tax, and as it is also known popularly as GST, is a type of indirect tax in India, which is levied on the supply of goods and services. The GST Tax Act came into effect on the 1st of July of 2017, launched by the President and the Government of India. Essentially, the purpose of the introduction of this GST was to replace many different indirect taxes which existed before. For example, VAT, excise duty, service tax, and many other local taxations present. And essentially, the introduction of the GST allowed for the universal, regulation and also return filing procedures, which allowed to be digitalized using a single online platform, and also to have to provide investors with clear compliance rules, and to make sure that they understand fully the GST requirements across the whole country. Essentially, despite the procedure of filing GST is digitalized, and it may seem that this is a rather simple thing. In fact, it is not that simple, especially for the new investors in India. So, especially in our practice, we do assist clients. For example, recently a client engaged in the renewable industry to actually register and then start filing the GST returns. Essentially, a standard GST registration procedure is one of the key requirements for the businesses to start the operations and to be able to issue invoices and basically get paid. Afterwards, the purpose is to generate some profits. And this is a general compliance service that we provide to our clients in India. GST tax rates vary, and on this slide I present some of the examples of different tax rates applicable to various items. For instance, 0% is applied to just generally all grocery items, everyday food items. 5% is applied to such things like household necessities, spices, tea, coffee, also life-saving drugs and services of small businesses and restaurants. 12% GST is applied to processed foods, certain items of clothing, and also other services, for example, business class air tickets. 18% GST is applied to items such as laptops, computers, cell phones, capital goods, industrial intermediaries, and also a little bit advanced services, for example, IT and telecom. And finally, the highest GST rate of 28% is applied to luxury items, which of course include premium cars, yachts, cigarettes, and high-end motorcycle, as well as like specialized services, for example, services of five-star hotels. Moving on to the corporate income tax. Corporate income tax is another significant fiscal, let's say, burden which companies in India face. So a resident company in India is taxed on its worldwide income compared to a non-resident company, which is only taxed on income that is received or occurred in India. So what it means that basically a resident company, which can be a privately limited company in India, so either it is a wholly owned subsidiary of an overseas company, or let's say it's a joint venture, it will be taxed on its worldwide income. The table on the right of this slide represents the three major corporate income tax rates. And the first one is 25%, which is applied to local companies, but with a turnover less than 4 billion Indian rupees, which is about 48 million euros. So for bigger companies operating in India, the domestic corporate income tax rate is 30%. And for foreign companies, which derive and extract profits from India, the corporate income tax rate is set at 40%, which is a significant burden. So this is actually should be considered by many overseas clients and overseas professionals and overseas businesses, which actually do a lot of activities with India but do not have any establishment there. So setting up an FDI, a foreign direct investment, might be a better option financially speaking. I also want to add that additional local surcharges and, for example, health surcharges, education cess of 4% are applied, but there are no local or state taxes on income in India, meaning that corporate income tax is applied universally across the whole country. I would also mention that, especially in our practice, assistance to some of our clients who are operating with very high profit margin, assistance with annual corporate income tax filing is essential in order to ensure the full compliance with the local regulation, but also to make sure that everything is fully accounted for in order to actually distribute the dividends to their overseas headquarters. One of the most sought after taxes for let's say expatriate in India, to foreign managers, to dispatched employees, to foreign staff, is of course personal income tax. So individual taxation in India, like in many other countries across the world, is based on the status of a resident. Meaning that an individual is considered to be a resident of India if he or she has resided in the country for a period of 182 days or more in a tax year. So essentially for half a year, if a person is living in India for half a year in the tax year. And there are two personal income tax regimes. And the latest one was introduced on the 1st of April 2020 with different 6 income brackets. Let me walk you through both of them. So the standard personal income tax regime has 4 brackets, and you can see on the slide, based on different income categories, a different tax rate will apply. However, as I mentioned, on the 1st of April 2020, the new personal tax regime was introduced with actually many, you can see there are definitely more tax brackets on the personal income, thus allowing for the lower income individuals to actually file less tax. However, this regime does not allow for the certain exemptions and deductions to be applied. Finally, I want to mention that, especially in our practice, actually many expatriates, let's say, they're based in Mumbai, they're based in Delhi, they come and say, oh, this is a bit complicated for me. Which personal income tax regime should I apply? In my country, it's not that complicated. What about social insurance? So in this case, usually, well, not usually, I mean, pretty much all the time, we take an individual approach with both an employee and the employer. And we try, we sit down, we try to figure out the best way in order to ensure the compliance in both India and also the country from which an employee was dispatched, but also to make sure all the, possible benefits, exemptions, tax deductions are taken into account in order to optimize the tax burden an individual may have in India. And finally, I just want to briefly mention several other taxes, which I believe are quite relevant for a lot of foreign investors in the country, being both existing or potential ones. So first of all is custom duty. Custom duty is a type of essentially an indirect taxation applied on import and export of goods at different rates. And of course, it depends on the type of good being exported or imported. Of course, custom duties are generally higher for certain categories of goods which are considered, let's say, undesirable or unwanted by the Indian authorities. They are generally levied on the import of goods. However, when it comes to export, they are only levied on the few categories of goods. Thus, in fact, export is quite encouraged. And actually, I'm going to touch a little bit upon this in the next slide. The next one of the, let's say, one of the most relevant taxes for investors, for overseas investors in India, is withholding tax on dividends. So, after making money, some investors would like to repatriate parts of it via dividends to its overseas headquarters. And of course, this is why it's important. Withholding tax on dividends is set at 10% to resident companies and at 20% to non-resident companies. But again, similar to other jurisdictions, the double tax treaty agreement, to avoid the double taxations, are in place between India and many countries across the world. So this always shall be considered when making an investment in the Indian marketplace. When it comes to taxation of capital assets, long-term capital gains are set at 10%, while the short-term capital gains are set at 15%. So thus, of course, the, let's say, longer-term and medium-term investment is encouraged much more by the authorities in India than the short-term. Finally, property tax. And in fact, we have a client who acquired some properties in India and for the rent purposes. And we have assisted with the calculation and understanding how the property tax in this specific scenario would work. It is generally paid by the landowner to the local government and paid once a year, but the formula to calculate would vary and is a bit tricky. So this is also something a little bit more technical and specialized to look into. And going into some of the fiscal incentives in India, of course, I will just briefly mention a few, but this is something, of course, let's say like a very juicy part. That's something investors are always trying to get, always trying to obtain some incentives in the country. So first, let's start with the startups. There are some categories of so-called eligible startups, which are engaged in certain businesses, for example, that could provide scalable business models to have a high potential local employment, to create wealth, to generate some social benefits. And these kind of startups would naturally be encouraged. It is applicable to new and already established startups as long as the turnover doesn't exceed 1 billion Indian rupees or about 12.1 million euros. Some incentives which are available are tax holidays for 3 consecutive years in respect to all the profits a company would make. And also fast tracking of patent applications with 80% rebate. So this is also something might be relevant to startups. I want to point out that actually in order to qualify for these so-called eligible startups incentives, a special certificate would be needed from the authorities. And again, this is the focus of one of our clients who actually is engaged, has set up, especially a new company in India and would like to obtain, is currently in the process of obtaining some of these startup incentives. As I mentioned on one of the previous slides, export is encouraged greatly in India. So deduction of, let's say, first of all, it's like 100% for the first 5 years of profits exempt from tax. And furthermore, partial exemption of 50% for the subsequent 5 years are also available. And basically, this is also, I would say, one of the key incentives, which is looked after by many manufacturers who set up their facilities, overseas manufacturers who set up their facilities in India and export a lot of products. And of course, we would take care of all the paperwork involved and understanding the regulations and subsequent negotiations if needed. The third incentive, which I point out here, is research and development, so-called super deduction, which is also relevant and applicable in many other countries. And this kind of super deduction is essentially a deduction to 100% of R&D expense, research and development expense, in approved in-house facility. And this is also extremely important to understand before you set up, let's say, an R&D center in India, to make sure that you meet all the requirements local authorities may have, to make sure that your in-house facility qualifies for this special, approval from the authorities in order to claim these research and development deductions. And finally, investment. This is rather general, but of course, based on the region and sector. For example, investment in infrastructure, investment in real estate development, such as affordable housing, let's say building up hospitals in rural areas, things like, transportation of goods or transportation of food. All these kind of investments are very much, welcome in India. And of course, some of the benefits, for example, could be tax rebates or tax holidays in the amount of up to 100%, really. So this is the last one, I would say, is a bit more customizable, and it is subject to negotiation with the local authorities and understanding their requirements, what is needed from, let's say, from a side of an overseas investor. And some of the key takeaways for today. So under the taxation system of India, taxes are levied by the central government, state government, and also municipalities levy minor taxes as well. As you may have seen, the fiscal pressure that businesses face in India could be significant and must be dealt with quickly and efficiently in order to make sure full compliance and also taking advantage of any local benefits and preferential policies available. And despite, taxation system of India being complex, in some ways it might be a bit confusing for foreign investors coming from, let's say, from Europe or from anywhere else with totally different taxation regime. I would say that an experienced lawyer and an experienced consultant, fiscal consultant, are a must before you would, consider setting up a subsidiary in India. And I would say that despite, this, which may seem like a tax burden, it is actually a great time to invest in the Indian marketplace and also, take care of all the, take advantage of all the policies available, especially in the post-COVID world. And that's all from my side. Thank you very much for listening. If you have any questions, please feel free to ask me later on or just send me an email afterwards. Thank you.